the TwentyFour Absolute Return Credit Fund is focused on risk-adjusted returns. So we only add bonds to this fund where the return we expect from them is enough to compensate for the additional incremental volatility that they'll add. For all asset classes, it's not that we're necessarily calling the end of the credit cycle, but I don't think any of us could say we would be surprised if we found ourselves in recession next year. There's a variety of warning signals out there. The US Treasury curve inverted in August. We're seeing Germany flirting with recession, industrial production's fallen off a cliff. If we look at global growth, it's just above 2%. The last two times we saw it as low as this was Q4 2011, the peripheral sovereign crisis, and Q1 2016. We saw a lot of market turbulence then. Meanwhile, we've still got big macro events overhanging the market. We could have a hard Brexit of the UK, and that wouldn't just be a problem for the United Kingdom, that would mean recession in Europe. And we've got the potential for the escalation of trade wars. Balanced against these, however, central banks will ease monetary policy, seeing that a slowdown is coming, but they have far less ammunition than they previously have. You can continue to cut rates below zero, but the transmission mechanism is not as efficient. The rate cuts are not passed as directly on to the wider economy. I think in markets where it's very difficult to tell which direction they're going to go in, it's not a high conviction call deciding exactly when the end of the cycle will come. Clients want to stick to strategies that are most transparent and least complicated. So I don't think that buying one high risk thing and selling another high risk thing necessarily leaves you free of risk, but I do think if you stick to strategies that are simple, where the inherent assets are low volatility, this is a good approach to what's a very difficult time.